Hey, good morning, everyone. It's a Sunday morning, and we are at June 29th, 2025. The stock market has been doing really well. And on this particular live stream, I have a returning guest, Daryl, who's a member of our Discord, has a lot of really interesting information. I like hearing his perspective on the market from a technical perspective. How you doing, Daryl?
Doing very well. Good to
Good to
good to see everyone again.
Yeah, and Daryl has a YouTube channel, and I put the YouTube details in the description of the video. And do me a giant favor and visit his channel, subscribe to his channel, watch his videos. I think he has a lot of good information to share, especially for guys like me. I'm probably I like to start with a company, understand their big picture, go into their financials, and kind of look at the value of the business from a financial statements perspective. But when I listen to Daryl, he comes from a perspective of some technical analysis, which opens my eyes to other things that maybe I didn't either see, I didn't appreciate, and I wasn't aware of. And I think it's value add for me. So I really like how you go about stocks.
Thank you. I appreciate it, Victor, and I think we complement each other fairly well. Fundamentals is something that I look at, but technicals tell me what people are doing on a daily basis, so that's why I focus on the technicals so heavily. But fundamentals are definitely an important part of the game. Keeps you out of some stocks that may be doing well temporarily, but don't have the foundation to really make them work over the long term.
Exactly, exactly. So good. So, the market's been going up, and every year the market's going to surprise us, right? We don't know the exact script that the market's going to follow. If we did, boy, this would be easy, but it wouldn't be as fun because what we're trying to do is we're trying to figure out, what's the best place to put capital in. Zubio is a commenter on the chat. And we are definitely going to talk about where we're investing. So stick around. We'll cover that over the next hour and 15 minutes. But as we look at the market, I'll kind of open up, and then I'd love for you, Daryl, to kind of take us through your thought pattern on what you're seeing in the market. I'm seeing that we had two terrific years in 2021, 2023, 2024, and coming into 2025, would I have liked an up year? Absolutely. Who wouldn't? But was I feeling like, hey, we got to give up some of these gains because 2 years in a row, just superb appreciation is really great, but can it go up a third year? And the way we headed into April, boy, it looked like okay, that expectation was going to be met, but it was very temporary because just after a couple weeks, the market kind of hit um, a bottom, and it's a V-shaped recovery of stocks, just a very a vertical V. It went down, it went up, and now we're sitting at all-time highs for the S&P. So I'll take it, but I wanted to get your thoughts on what you've seen in the market. If you want to share your screen, that'd be awesome.
Sure.
And while you do that, good morning, Noam. Good to see you. And you've got a question out there, which is, do you think there'll be some coiled value in the RE sector? So the real estate sector. Okay, let me note that. We can come back to it.
That's where I am heavily invested. I am very overweight in real estate.
Mm-hmm.
So
Yeah,
let's
go
take
ahead.
a look at the SPX over the last year. And we reached an all-time high on February the 19th at 61.44.15. And then we had the precipitous drop related to the tariff announcements. And then we've since made our way back up to all-time highs, closing on Friday at an all-time high. So I have this resistance line setting here. We're also getting ready. We're trading above the 20-day, the 50-day, and the 200-day. The gold line is the 20-day. Blue line is the 50-day. The red line is the 200-day. And I don't know if you remember all the news that was in the media around April the 10th or so when we had the death cross where the 50-day crosses the 200. That's actually a good time to start buying. The media makes it sound like we're going to go into the abyss at that point. But if you look at the price action when that happened, that was actually a pretty good time to be buying. And here in probably this week, I expect that we're going to have what they call a golden cross, which is where the 50-day crosses above the 200. And if you wait for that signal, then you've probably waited a little bit too long to get back in and take advantage of all this upward movement. But it still may not be a bad time to move in. We typically continue to increase after getting that golden cross. If we look at the relative strength for the SPX, we're sitting at an overbought condition, just barely. We're sitting above the 70 line. So we're sitting at 70.21. So we are in an overbought condition. But you can stay in that condition for quite some time. If I go back just maybe a couple of years.
Before you jump, if you can jump back, I wanted to kind of just confirm a few things that you just said.
Okay.
Maybe for my validation that I understand it, and then maybe some newer investors can kind of understand what we're talking about. So I love your discussion around the death cross, right? And that was a time when the media was, just talking that, hey, it's going to be really, really bad. There's going to be like huge inflation. There's going to be a global tariff war. So absolutely, it's a good time to buy. And you always have to kind of think logically and not emotionally in those times. So got that. Now, when you talk about, I think you were talking about the RSI being just slightly above 70.
Yeah.
And if the RSI is 100, that means we're in very overbought conditions. If the RSI is at 0, that means we're way oversold. So your interpretation, if you can go into that a little deeper, just to make sure we all get it, a little over 70, kind of give me that definition again.
Yeah, 70 is the upper end. When you start getting over 70, you start getting into what they call an overbought condition. So if I just move back out to 2 years, when you start getting into an overbought condition, it can actually stay there for a little while. So you can see right here that we were at 70, but we continued to progress for it looks like almost 2 or 3 weeks where we continued upward. And then typically you'll start finding fewer and fewer buyers at that point. You have more sellers than you do buyers. So you're going to start seeing a decrease in that relative strength. So 70 is that cutoff line. I always mark those with a couple lines just so I can keep them in the forefront of my mind. Here's another one where we went into an overbought condition and we stayed there for quite some time. We dipped down just a little bit and then ran back up to about 80, which is very overbought. But eventually that led to a pretty steep decline here from July down to August the 6th during the yen carry trade fiasco last year.
Yep.
And then when you get below 30, that's oversold. And that's where you're starting to lose. Sellers and buyers typically start coming back in to the market. And then you can see the relative strength started increasing. And we had the really good run up over the last 6 weeks, 8 weeks.
Mhm.
And then
Okay,
another, yep, go ahead.
So just jumping off point, so we're with a slightly, or I should say, overbought condition of RSI being above 70. So right now, I've been saying, okay, I'm going to be patient, meaning I'm not going to reach for stocks. I'm not going to buy them, if I think they're expensive, just because right now we're overbought. Stocks are expensive. So let's, I don't want to chase stocks into high prices. But it doesn't mean, hey, I'm going to sell half my portfolio. It doesn't mean that to
Exactly.
me. It may mean
No.
that to somebody else, but it doesn't mean that to me. I'm sticking to my winners. I'm not selling these awesome businesses. Maybe how are you, in a general sense, kind of planning your investment for the month of July, given the situation we're in?
I am fully invested at the moment. So I have very little cash on the sidelines. I'm expecting July to actually perform pretty well. We can take a look at a seasonality chart for the SPX. And if you look at July over the last 10 years, 100% of the time, the SPX has closed higher than it opened. 100% of the time. And the
100%.
average increase
How
was
many years are you including here?
I'm looking at 10, but I can go back to 20. And July is still 79% of the time. And the average increase is 2.5% on average.
Okay.
Now, when we move to the next 2 months, August and September, we're going to, on a seasonality perspective, that's a couple of the weakest months that we have. So I'm expecting July to perform pretty well. I think earnings are going to come pretty much in line. I think that's going to help for July. August and September are typically pretty flat months.
Interesting. And I'm trying to kind of, I love when, statistics and data paint a picture for you that I can kind of compare to, like, what am I rationally seeing, right? Like,
Right.
as I think about where the market's at, it just punched through an all-time high. It had gotten up there before and it kind of faded and so forth. Punching through that all-time high will do a couple of things. First is emotionally, I think the market's going to be like, oh, go, go, go. And they'll be buying just based on, hey, the market is flourishing. I want to put more capital to work. And second thing is, I think there's a lot of price. There's a lot of buying that just happens based on a pricing being reset on people's investing mechanics. So those two things, I'm seeing that more the emotional, hey, we just punched through that all-time high, and I think the market's going to move higher. And I do agree that it's kind of temporary. It's a little bit like, okay, it's going to punch through, but hey, it's not going to be like, hey, it's going to be a steady, upward trend for the next 12 months. I think we can have a nice 15, 20-day run. and then we start to see it kind of fade, and then we can see it fade for a couple months, potentially, maybe a month. So I think right now being patient, not chasing stocks is a good idea. Maybe accumulating a little capital. If you're still working out there and you're like, making good money and you're putting it away, great. Maybe put it in cash or some type of, interest earning vehicle, and just be patient. Don't jump in head first, because we may wake up 2-3 months from now and it's like, whoa, that was a nice 10% correction.
Yeah.
Very good. So
Couple,
looks like we've got Shadow Guy on. Hi, Shadow Guy. And Enkiter's on. Good to see you. We could talk about real estate. And then Rotel and Cheese, good to see you guys. And then, hi, guys. Not many people talking about the DXY falling. Do you think any particular sectors could benefit from this fall? Eyeing commodities, particularly metal miners like Rio Tinto, BHP, thanks. Yeah, I can talk about that later. And from here, let me check in with you, Daryl. Do you have more to share? Because what you're sharing is really interesting. You have more to share?
I have a few more charts that we could share that might
Mhm.
be helpful. So this is looking at offense versus defense. As we moved into February, where we finally got to our high, one of the really concerning things was we had, excuse me, let me get to the right line here. We actually had decreasing, or what they call negative convergence. So this should have been a signal that we were in for the decline that we saw in late February and early March. Not necessarily the tariffs, because that was an event that occurred, but this decline here from the third week of February down to March, we had some signals that were, okay, I'm going to move that around. Those lines are going to disappear. But we had negative convergence. That should have been a signal. The interesting thing now is we're seeing this big, huge increase, but we're seeing a very large positive convergence. Now we're seeing people move into offense. So this is the QQQ versus the SPY. This is consumer
Give me a quick
discretionary.
definition. When you say offense, people are moving into offense. What does that mean?
So if we look, your offensive sectors are XLK, your XLI, your XLC. Those sectors are offensive. Real estate is defensive. Commodities, materials are defensive. So people were starting to move out of those sectors into more offensive sectors. Anytime that we see a large increase in the SPY or the NASDAQ, those are going to be led by the offensive sectors, XLK, XLC, XLI. They're going to be moved by those sectors, because XLK, XLC account for what, 40 or 45% of the SPX. So when they're moving, you're going to have a higher SPX. So
So
going
I've heard
into,
the term risk on out there, like risk on, risk off.
this is risk on.
Correct.
So offense is in the lead. That is risk on.
Awesome. Okay.
So that was consumer discretionary versus staples. Staples are defensive. Discretionary is offensive. 2/3 of our economy, the United States economy, is consumer driven. So when people are buying what they want instead of what they need, that's offense. And that accounts for 2/3 of our economy. And then I have 3, growth versus value. So large cap growth over large cap value. We also see positive convergence, where before we had negative convergence going into the end of February. For mid cap growth versus mid cap value, this was a little later to start playing the negative divergence game, but now you see people moving into growth and not value. So staples, they're moving out of staples and moving back on to risk on or growth. And then here's your small caps. And even those, we're seeing small cap growth outperforming small cap value.
Mhm.
That's a
So,
really good sign going into July as well.
so good point to kind of mix in a thought that I'm having is, so oftentimes I love buying in spaces where everybody dislikes it, is ignoring it, is forgotten the space. So right now, as we have risk on, right, we have things are people are going in offense. For me, I'm thinking, well, I'm going to go look for at safety stocks, because if the market's going to start giving me really good discounts, maybe that's a good place to go, because I'm not looking for a return on that stock for the next 60 days, but I could do really well over the next year if my intuition is correct. And I'd buy
Exactly. And that's
a
a
stock
good
that's really
strategy,
discounted.
depending on whether you're trying to make money in the next month or whether you're a long-term investor. So
I want to make the maximum amount of money. And
yeah,
that's really my strategy is long term. Let my capital compound, let my gains compound, and build the biggest portfolio for the future. Short term, I mean, I think when I limit myself to a short term gain, and I'm not speaking for everybody, obviously, we all invest the way we want to invest and based on what we want to accomplish. But that's what I mean is, like, I'm trying to outsmart the market every year, and I'm trying to put together very good 5-year runs and then very good decades, and just continue to grow my net worth. That's what I'm trying to do. That's the overall goal. How I accomplish it is year to year try to make the right moves that are going to benefit me for the next 12 months to 2 years.
yeah.
That's what I'm thinking.
And right now I'm in a position where I retired 5 years ago, but I'm still not at retirement age for Social Security. So I have a gap over this 5 or 6 year period that I have to fill. So I have
Mm-hmm.
a small pension that is taking care of part of my expenses. And then I am a heavy income investor right now. So our goals are a little bit different. And that's really important for us to understand. We're all individuals, we all have different strategies. My strategy was exactly the same as yours for the first 40 years of my investment career. I just wanted it to grow. I didn't care about dividends. I didn't care about getting income back at that point. I just wanted the value to grow. And then I had to switch priorities in 2021 where I needed to fill a gap between my expenses and the small pension that I had. When I start Social Security, that's going to fill a fairly large gap that I'm trying to fill currently with income. So my strategy will once again shift, probably within the next 2 years. It's going to shift again from a high income strategy to a lower income and more growth. So it's important, especially if we have any young people in the audience, that your strategy may change over the years.
Mm-hmm. It should change.
Yep.
You know, because you change, right? Like
Yep.
30 years ago, I didn't have any kids. 30
Yep.
years ago, it was like I had discretionary income coming out of my ears.
Yep.
And then my kids were born, and they became, you know, the centerpiece to my wife and I's family and life, and that became really important. So I made sure college funds were completely funded. You know, started thinking about more legacy kind of planning. Like, hey, I want my kids to have a better life. Not a unique thought. So I started thinking, hey, I want to build the biggest portfolio that I could live very comfortably with, very happy with, me individually, my wife, but I could also set my kids up quite well. And that became my purpose. And you're right about that. And I'll probably wake up 5 years from now and have a different perspective. I'll probably wake up 20 years from now and have a completely different perspective. Like, hey, my values have changed a little bit. Good stuff.
Two more quick charts.
Mm-hmm.
One is the VIX that measures volatility, and the media refers to it as a fear gauge. We shot up in April all the way to this 52.33, which is incredibly high. And that's when the market reached its bottom. We've been steadily declining. And one of the lines that I look at is this 20. When we're below 20, there tends to be a whole lot less fear in the market. We're not back down to our lows where we were in the 14 range back in the beginning of the year, but we are back down to 16, and it looks like we're still decreasing. So that's a really good sign for July. And then the last.
Can you wait there for a second? There for a second? So Warren Buffett's voice came into my head. Be fearful when everybody's greedy. And I just feel like, you know, we just had like April really caught my attention. It's like, holy smokes, like that was real. Okay. That the S&P went down like 19% in a month. And it's like, wow, that was fast and that was real. And that's just a couple months removed from where we're at today. And for the market to be this comfortable scares me. It's like, what? We're here this quickly? I'm like not scared like, oh my God, I'm gonna sell my stocks. But just it catches my attention that how can we be this calm after we just dealt with April?
Well, the good news is 19% down, although that's painful. It did not put us into a bear market. The official amount is 20%. So we did not enter a bear market, even though it felt like it.
So it was a correction, but not
it was a correction. It was a deep correction. So we are still in a bull market that started at the end of 2020, 2021.
And you know, psychologically,
we're about 2.5 years into this bull market. The typical bull market lasts 5 years.
So again, psychologically, I think the market might be feeling even more braver. Like, oh, we dealt with April. That was no big deal. We're going higher. We'll see how high we go. But it'll be interesting to track that. We should definitely do more live streams. I'd love to get your technical viewpoint because all this data makes total sense to me. Please carry on.
Okay, just one more that I thought about after you and I talked yesterday. I saw a gentleman show this one in a stream yesterday, and I thought it was pretty interesting. So this is the semiconductor industry. versus the SPX. So basically from the beginning of the year all the way through April and then back through this point here, we actually had a breakthrough in May. Once again, indicating that was a solid time to really start moving back into very aggressive groups like semiconductors. So we had that breakthrough here, and you can see what's happened since. So that's the last chart that I had.
So let me ask you on this chart here, what's your expectation, right? What's your best guess? Is semiconductor going to keep going higher, or is it like, okay, it's getting a little too hot. I think it's got to cool off.
I think semiconductors are going higher for a while. I look at
this is technical speak, right? This is not like your business mind. This is your technical mind.
Yep. So if we look at my portfolio and look at NVIDIA, which I'm still in. One other chart that I could show on NVIDIA first. I have a chart set up in two different chart lists. So I follow a young lady named Danielle Shea. She is a options trader, but she always has some really good insights on various stocks. And NVIDIA was one that she mentioned the other day. She relies heavily on an indicator called the TTM squeeze. And typically what happens when you get into a squeeze, and it started on about 624, we're basically 3 days into this squeeze, and those typically go on for about 10 days. So I'm expecting NVIDIA to just keep pressing higher over at least the next week, week and a half. If we pull back to a weekly view, these can go anywhere from 6 to 10 weeks as well. We're only in the second week of this squeeze. And over that couple of days, we're up from 144 to 157. So I'm expecting NVIDIA to keep going for the next week or two.
So do you think it'll touch 4 trillion in market cap? Because right now it's at like 3.8 trillion.
Yeah, I don't know how many points we need to be to get it to 4. It'd be easy calculation. I don't have them right.
It's at 3.85 trillion, so we need 150 billion. So it's got to go up 4.5 points.
Yeah,
4.5%, and we're there.
I think that is probably attainable. So anyway, I'm playing this one.
Cool. So I'm gonna share with you my position, or my guess on NVIDIA is I don't think it's gonna get to 4 trillion. I just don't think that's a lot of capital to be deployed into one stock, and I think the market's going to kind of catch itself before it gets to 4 trillion. That's my best guess. We'll see. Maybe on the next live stream we'll check in on that. And
okay.
It might be at 5 trillion. I'll be like, hey, I was wrong. Good stuff. Great stuff. So let's kind of get into the question that was asked earlier, and just to kind of put an agenda out there for everybody. We're going to talk about real estate. It was brought up by Enkider, and we could just have some comments around real estate, where it's going to go based on, I'll let you lead, and then I'll chime in. And then we did want to go into looking at stocks that are in the asset management industry and I'll explain why we're looking at those stocks just as an idea. Might be a little early, might not be the right time to think about those stocks, but I thought it'd be interesting research to share with everybody. So let's talk about real estate. And interest rates are expected to go down. Real estate's, I mean, I, I'll let you lead the conversation on real estate, and then I've got a lot to say on it. But,
Okay.
what do you think about real estate as an investment right now?
I've been heavily in real estate for the last 2 or 3 years because of the income. That's mainly why I moved into it. But at the first talk of interest rate cuts last year, real estate really started moving up. And I have I at least have one that's up 40% over the last year.
Great.
So, yeah, so it's been really, really good. So here is a view of the CME FedWatch tool.
Mm-hmm.
So they're not expected to cut rates at the July meeting, but these odds are actually increasing that they will cut rates in July. So one thing that I've been looking at that I think is pretty fascinating, if I go and look at the Treasury rates and I look at the 1 month Treasury rate, you see how when there were no talks of interest rate cuts, how it just pivoted around this 429 level. This is the 1 month Treasury rate. Look at what happened at the beginning of June. The Treasury markets are sniffing out that there is going to be a rate cut in July.
Yeah.
Although Powell says he's waiting on data, I actually think he's typically looking at the wrong thing at this point, but that's just my opinion. The Treasury market is definitely sensing that there is going to be a rate cut in July. And if you look back over the last even 2 or 3 years, the Treasury market has been right every single time.
Yeah.
So let's go back to the FedWatch. So they're expecting their first cut in September.
And your screen is super tiny. I don't know if you can make it
Okay,
bigger.
let me make it a little bit bigger.
There we go.
So they're expecting no cut in July. Here's the meeting date. Here's the probability, and the interest rates are across the top. So the first cut is expected in September. There's a 91.9% probability that they're going to do that. This 18.6 has been increasing over the last week or two. It's not anywhere near 50% yet, but I think by the time we get closer and closer to July, this is going to be a little bit higher. Expecting the next cut in October, another one in December. So the Fed so far has said they expect 2 rate cuts. The market's expecting 4. And then January stays.
Hold on. You lost me because we haven't had any cuts in 2025, have we?
No. Last
So
one was.
How did you get to 4?
This is for. Yeah, this is for 20 all the way through 2025, the end of the year, December. So here's one.
So we would see
2,
one in July,
3. Okay,
September,
3 cuts.
October. Okay, got it.
3 cuts.
Okay, just shows that I'm paying attention, Daryl.
Yes. So the Fed has said 2. They expect 2. The market's expecting 3.
Got it.
And then they're expecting.
Let's reflect on that for a second,
2.
just from a high level kind of. I always try to like make conversation around business. Does this make business sense, right? So unemployment's getting weaker, but not drastically. Like we don't have a big unemployment problem, but you have the continuing jobless claim number continues to get bigger. And I think the economy, first quarter GDP was negative. That's another signal that, hey, the economy is not booming. So you got, I'm going to call it a lukewarm economy. Unemployment is not a big problem, but it's not doing great either. So we're almost in that like lukewarm, kind of cold economy. So can it kind of be kicked into a little bit of a warmer position, a little bit more active, more jobs and so forth? It most certainly can, so long as the inflation doesn't, become, if inflation comes into the picture and starts reading high, I think some bets are off, right?
Yeah.
Okay, cool. All right. So, and one more question, which is, so we get to July and the Fed says, hey, we're going to cut by a quarter point, quarter of a percent. The market is going to go up. The market's going to be like, yeah, all right, great. Because that's a signal that rates are going to go down more than we expected. And the market's going to have, I'm going to call it kind of an artificial rally. It's not based on fundamentals, just based on, all right, great. We're going into a lower interest rate environment. That's what I'm expecting.
Yep. One other interesting thing is the Fed rate is sitting at 4.25, and the 2-year Treasury yield is 3.7. So the overnight rate is higher than the 2-year Treasury. So it needs
What is
to
that?
come. Yeah, it's just telling us that the Fed rate needs to come down.
Okay, perfect. All right, so just staying on real estate, and then we'll move on to the next topic of asset management companies. What are some of your investing ideas in real estate investment trusts and so forth?
Let me show you my holdings in real estate and how they're performing on a relative rotation graph. So let's get that to center. So you can see that real estate, about 5 weeks ago, they were all in the green. So they were all performing very well. They have turned down and they're into the weakening zone, which means their relative strength is still above 1, but their momentum has slowed. If we start getting interest rate cuts, I expect these to start turning around very quickly. I do have this one speculative position, MPW, which I don't own very much of it. It's less than 1%, or maybe right around 1% of my portfolio. I think they're a 2 or 3 year turnaround, so I don't look at that one too terribly much. But the rest of these are my core real estate holdings, and they've been doing fairly well. They've been in this upper right hand coordinate and are weakening slightly, but I believe that as soon as we start getting even hints of interest rate cuts, that these are going to start rolling back around. These start decreasing when risk on comes back into the market, and that's where we are right now. So nothing bothers me here because these are very high yielding holdings.
Great. Yeah, I think real estate, man, it's been, so I'm going to talk about real estate in 2 ways. One is through, I own CTRE, and it's been a good holding. It's done well over the 5-year. It pays a nice dividend. And if real estate if interest rates go down, I think it's going to do well. So Carry Trust I just kind of keep it, does its thing, and I'm fine. But I also own individual properties that I rent out to people. And that market has been absolutely impossible to figure out.
Yeah.
It's like, why did properties go up during the COVID year? I'm like, I don't get that at all. But later on, the market taught me a lesson, which was scarcity rules.
Yeah.
We have such scarcity in Southern California that people were just, they're buying properties irrationally. They're paying so much for that. It's like, God, it's nuts. Um, so I'm not investing in individual properties. I've been wanting to invest in individual properties, but the pricing is just completely uninvestable. It's just I give up too much flexibility in my capital in buying real estate, and I take too much risk because what we saw in 2008, 2009, 2010, in my lifetime, I've seen two times when real estate went down in Southern California. One was a very shallow drop, super shallow. You don't pay attention, you can't even see it. And that was that. But then there was in Orange County, California, which is a very nice place to be, um, to live in, and very nice place to live. It went down 40% real estate property values inland
What time
to
frame?
where this is 2008, 2009, 2010.
Okay. Yep.
If you go inland, property values went down 60%. This is like people's homes. So that was a great time to buy. It was like nobody wanted to buy real estate.
Yeah.
I bought real estate. So I don't think I'm ever going to see that again. But it really did spoil me because I'm like now a stricter real estate investor, individual properties. And what I love about stocks is their liquidity. I could
Yeah.
wake up tomorrow and sell all my CTRE and have
Yeah.
the cash, out of my account within a couple of days. If you
Right.
buy a property, it's going to take you 60 days from the time you say I do to the time when you close escrow and you have the property. You can start doing something with it. And to get out of it, you're probably looking at 6 months. So you can't get in and get out. You got to be very careful with that. So as we deal with real estate, there might be some good opportunities. The opportunity that I keep kind of coming back to is commercial, because commercial got just destroyed due to COVID. And now you're seeing companies require their employees to go back to the office. You're
Right.
seeing certain cities. What also has been really interesting is you have the mega cities, New York, Los Angeles. I think those cities lost population, and that population, went to smaller cities. Smaller cities are now probably having commercial real estate markets that are flourishing because they're like, hey, we weren't built to have, let's say you're a city, you had a population of 300,000, 500,000, and you had employers that had enough capacity for that type of population. Well, a lot of people like your city, so they move there and they increase the population by 10, 15%. That's going to create a lot of demand for commercial real estate. And I think that might be an opportunity to take a look at in real estate.
Yep.
So we'll see how that plays out. I can see how real estate investment trusts are really important to investors that want income. All right, cool. So let's flip over to the last topic of the stream, and that's as we look at, if you can, I'm going to take your screen off, and I'm going to
Okay.
share my screen. As we look at the market, right, I'm looking at, this is the year to date. And to make things even more interesting, let's look at the 3-year. Over the last 3 years, if you were in NVIDIA, congratulations. If you were in Broadcom, congratulations. You got to have like huge number. Netflix, huge appreciation. Meta, huge appreciation. So things have worked out really nicely. Now we find ourselves, I think, the conversation that you and I have had to this point, there's a sense that the market's overbought. That, hey, it's probably going to keep running up because the momentum of the market is just going to carry it into July. July is probably going to be a good month. But where is there a sector that maybe is a good place to look for the next idea? And the idea that I've been kind of kicking around has been in financials. The financials are doing well. And I think with lower interest rates, that makes their cost of capital go down. And I arrived at, hey, I'm going to look, because here's the sector of financials and all the industries that belong to it. I'm going to dive into asset management. And within asset management, you have companies like Blackstone, BlackRock, KKR, Brookfield Asset Management, Apollo. And these guys are buying companies. They're buying portions of companies. They're buying real estate. They kind of are going where the investments are ideal or provide an opportunity. Now, this is like initial steps, right? I'm not ready to buy any one stock, but I thought we could take a deep dive on some of these, and I'd love to get your thoughts on a few of these. We'll start with the biggest one, Blackstone. We'll get through as many as we can in the next 15, 20 minutes, and then I've got to go. I think you have to go as well. So let's get into it. So Blackstone's the biggest one. It is a $184 billion market cap company, and it has a pretty high PE of 45 for the current year. It pays a dividend, 2.67. The stock has done really well over the 5-year, 178%. It had that big pullback. Now, when I looked at these, these guys are not banks, but they're not companies like NVIDIA either. NVIDIA has designed a really great product. They have patents on it. They have the product made and they sell it to somebody, and then that somebody gives them money and they create cash flow. That's kind of the classical product-based company. Well, Blackstone's they're using capital, they're buying things, they're holding them, they're making loans. In some cases, you can say they're making net interest margin. And so I didn't know how to exactly value them. So I'm going to treat them more like a bank. I'm going to look at book value, and I'm going to look at earnings per share when I value these, because I'm not going to value them on cash flow, because some of these don't cash flow.
I also look at the book value. That's my primary thing. If they're 10% below book value, then I snatch them up. If they're above their book value, I'm a little bit more cautious.
Okay. So let's take a look at their overall book value. And I actually prepared a little schedule here. I'm going to make this bigger because I think it's tiny. So this is kind of like the summary. All right, here we go. So this is Blackstone, this is BlackRock, KKR, Brookfield, Apollo, Ares Corporation, and this is Ares Capital.
Yeah, that's the only one that I own.
And you own this one. I see the book value is pretty decent on that one. That's the best book value of them all. Here's the price to book. And some of these are really expensive, 14, 12. This one's good. Banks like Citi is got a pretty good price to book. Currently, it's like 1.2 or something, 1.1. But all these are pretty expensive. 14 is really expensive. This one's a little more agreeable. Brookfield is far closer. but these are pretty expensive on that ratio. PEs are pretty high. I mean, if I'm paying 45, I'm way more comfortable in a tech stock that I feel like, oh, that technology is worth a lot. That technology is going to create a company that's going to go from 1 billion in revenue to 20 billion. I just see the line or the path of that company. But these guys, it's like a P of 45. Man, it's expensive. The least expensive one is Ares Capital. So that one's probably the best choice just based on the costing.
And they have a yield of 8.75%, so that's why they're sitting in my portfolio, and I'm in it below book value.
Good job. And these guys, so Ares Capital, they specialize in acquisition, recapitalization, mezzanine debt, restructurings, rescue financing, leverage buyouts. Okay. So they're looking for like businesses that are really struggling, and they come in and make them a deal they can't refuse. They either take my financing or you go bankrupt. So therefore, we're going to own a big part of your company, or we're going to get something out of it. You're going to pay a high interest rate or something, right?
Pretty good way of looking at it. That's pretty much the way they operate.
And the stock has appreciated. So if you look at 57%, but you look at this dividend over 5 years, you compounded 45, 50% return on the dividend itself. And then you have this 57% of price appreciation. So it's a good stock. It just seems like this market is expensive. This is the best one of the lot. And when you look at the others, you have like BlackRock, you have P at 25, which again, I think it's expensive because these guys don't make anything. They're just making money off holding things. I could get a better PE from a bank. Dividend is 2%. Okay, that's fine. The stock has appreciated, so that looks good. But the other fundamentals don't look good. So that's BlackRock. KKR, very high PE, very low dividend. And they've done really well. So this idea was a good one 5 years ago, or maybe 3 years ago. But that's why I do the research.
Yeah, another
This
one that
research
falls into this category that a lot of people invest in is Main, MAIN. They're another business development corporation. A little more expensive than Ares Capital.
What was this ticker again?
MAIN, Main.
Main Street Capital. Hmm? Interesting. Yeah. The one thing, let me look at Citi. Citi's PE ratio of 13, 11. Price to book is reasonable on Citi. And Citi's, to me, is like the least expensive big bank. That's why I bought it. And I sold my JP Morgan. Price to book ratio, 0.81. So that's, maybe I should just buy more Citi.
And they just completed their acquisition of Discovery, right? Oh, that's Capital One. Capital One. Never mind.
Yeah. So, yeah, well, my research has paid off. I think I'm going to avoid this space because it's too expensive. I didn't lose any money, which is a gain. Maybe I'm going to just revisit buying more Citigroup. Any final thoughts on this space?
Not from me. I know private credit is starting to get a lot of action where they're trying to get ETFs and stuff created for the public markets because the public markets are wanting to get more involved in these private credit groups. So we'll
Hmm.
see how that turns out.
Yeah. The other thing I've heard in banking is that the banks right now have kind of a costlier model that they've had in the distant past, because coming out of the great financial crisis, the government decided, hey, you guys were taking a lot of risk. We ended up having to bail a lot of institutions out. So we want you to have more reserves in proportion to the amount of money you have lent out. Well, that doesn't give banks, it takes away the ability to be more profitable. Well, they're going to lower those standards. That's going to make banks more profitable. So that is also a tailwind that I think banks are going to receive. All right. So, well, that was a really cool stream. Let's get. Um, I'd love to stream with you again, and maybe if you wouldn't mind, if you can put up your channel so people know your channel. I'm going to remove my screen, and then everybody, hop onto Daryl's channel when you get a minute, and subscribe to his channel, like his videos, kind of help him grow his channel, because he brings a lot of information to our Discord. And I think in this live stream, I'm walking away, a little smarter and kind of able to view the markets from a different lens, which is great because it kind of either reinforces something that I thought I knew, or it makes me think about it differently. Like, hey, that makes a lot of sense. Um, so go for it, Daryl.
Okay. Let's see. Oh, there I am sharing. Okay, so one of the things I've really been focusing on the last quarter is reviewing all of my holdings as they move into the earnings, showing if they have positive relative strength and have good momentum, or whether they're showing weakness going into the earnings. So I share all that information for each one of my holdings. And since we're getting ready to go back into earnings season, you'll be seeing quite a few of these videos coming out over the next 6 weeks or so.
Quick
2
question.
months.
So, quick question is relative strength. What does that mean to you?
It's performing better than the market. So it is showing strength in the market. Anything above 50 is positive relative strength. So we had the 30 line, we had the 70 line. The 50 line is in the middle. Anything above 50, it's showing positive relative strength. Anything below 50, it's showing negative relative strength.
Okay. Perfect. So yeah. So as we go into earnings, I think we had a good watch party for NVIDIA. Maybe around the big earnings, we could do watch parties, and you go the technical route, I'll go the fundamental route, and kind of will, tear apart the financials that our company comes out with.
Yep, sounds
That'd
great.
be really fun.
Yep, I enjoy
Earnings
doing that
coming,
as
and
well.
it's going to be super busy for about a month.
Yes, I know I had 1 week last earnings quarter that I had 19 companies reporting in 1 week. So that was a crazy week trying to get 19 videos out, even though they're short, they're only 10 minutes or so. That was a lot of time on the video.
Yeah. All right. So let me just say, let me answer some questions, and then we'll end the show here. So it looks like Jay Zeb Good morning. Good to see you. So Shadow Guy. So idea to look at Swiss banks. Not a bad idea. Uh, Switzerland is very well known for financial, its financial markets. So, and it looks like they're opening up other markets for Swiss banks. And then it's NU3RA. Good to see you. Yeah, we covered KKR just briefly. It looks like Pops Mafia, Palantir pre-market Monday should be interesting. It always is interesting with Palantir. That's might be the most interesting stock. Top 5, because NVIDIA is pretty interesting too. But Palantir has been super interesting. Cool. And again, Nkiter, thanks for tuning in. Josh, good to see you. Rotel and Cheese, Zubia, awesome. So that was a fun stream. Thanks so much. I'll check in with you, and we'll see when we can do this again. Everybody, again, please visit Daryl's channel. Give me your support. Give him a subscribe, and watch his videos. So with that,
Thank you, Victor.
enjoy your weekend. We'll see
All
you, Daryl.
right. You guys too. Have a good week.